building going up in Zimbabwe, every mine being developed underground, every power project and every solar plant being commissioned, none of that infrastructure works without cables that connects to it. And that is where CAFCA Limited, Zimbabwe's only listed cables manufacturer and reliable supplier, comes into play. Today we are joined by the company's Chief Executive Officer, Vimbai Nyakudya, to discuss and unpack the just released half-year financials against the backdrop of Zimbabwe's fast-moving economy. For this conversation and more about economic development in the country, please stay tuned. It really feels home here. Thank you, Mr. Nyakudya, for giving us another chance to speak with you again.
No, thank you, Blessing. The pleasure is all mine.
Let us start with the most interesting aspect. You have just continued your profitability journey from Zimplow, and here at CAFCA you're also making records. We have seen a revenue rise of 24% and a profitability spike of 211%, which we have attributed to cost optimization strategies as well as volumes growth. But the ninefold variance between revenue and profitability, it shows probably something like a structural improvement in your cost base or a very low base effect from first half of 2025. So among the two, which explains the heavy lifting of the performance, and among the two, how much of the margin expansion is structural versus base effect driven?
We had a very good 6 months or first half of the year. Our performance was mostly anchored on the revenue growth as well as the cost optimization. But you speak of the ninefold growth on the bottom line. That was mostly because of the operating leverage. So our business is structured in the sense that most of our costs are fixed, both the conversion as well as the administrative. So once you pass the break-even point, whatever that is coming through from the top is going straight down to the bottom. So that's what happened. So the growth that we achieved on the volume side as well as the revenue side, from a pricing perspective, it really helped us in the performance that then followed on the bottom line. But what is key to note is that the performance that came through was as a result of some of the interventions that we put through in the previous year. When I got here, obviously, I had to look at the different factors that had been impacting on performance, and one of the interventions was to optimize on the cost base, where in terms of capacity utilization, we had to look at ways or interventions that would give us more production using a low base in terms of resources, and that we did. You might recall that we did a staff rationalization strategy towards the end of the third quarter of our financial year. So that is, those are the things that we, some of the things that we did. Also, over and above that, we had to look at the ways in which we manage our supply chain. So one of the factors that have been impacting our performance generally has been the misalignments between our supply chain and our production. And that is what we had to look at and intervene to ensure that the cost base that is there is sufficient for the purposes of producing the same output as we were producing last year with a bigger cost base. So that intervention helped. Over and above that, the other element was to do with equipment reliability. I think as we come from previous years, there were certain things that we had sort of like accepted within our system. And when I came in, we had to rethink and reset so that the equipment reliability improves, the capacity utilization also improves, And therefore, again, the cost base, the smaller cost base that we had adopted would be sufficient to produce the top line. So with that cost base that we now have, like I was saying, that the operating leverage, once you pass that break-even point, the growth on the bottom line therefore outstrips whatever that you'll be seeing on the revenue side or on the volume side.
So on the cost optimization strategy, staff rationalization was one of the factors. Did you factor in also artificial intelligence, or it's something that is within the pipeline?
So it's still in the pipeline. So with artificial intelligence, because we have got three major areas that we are looking to benefit from artificial intelligence. Obviously, the first part is on the marketing or sales side, where we would like that demand management, the aspect of producing quotations, servicing the customer, to be supported by artificial intelligence. The third part, the second part is on the production optimization, on the process capability. So we have got about more than 120 lines that we produce, and each and every one of them demand different setup capabilities, and it demands different process capabilities from intelligence, from how you handle the compound, how you draw the wire, and those things, in order to achieve that process capability or that consistency in delivery. We feel that artificial intelligence will help us there. Then the third aspect is also on the maintenance engineering, because we have, with our process, with the different handling, accommodation, it impacts on the equipment use. And if you then look at the different factors that impact equipment use, using our human intervention, we are sort of like losing some productivity. We are losing productivity along the way, and therefore, in those areas, we feel that we need to adopt artificial intelligence so that we prioritize or we improve our productivity. But however, with artificial intelligence, you need to have a good base in terms of databases, in terms of information processing, and that is what we are working on at the current moment. So we hope that will happen sooner, and once we have got the right applications from an artificial intelligence that we can plug into our data, off we go, but it will be soon.
Now, if we look even your operations, we have seen that your operating margins improved from 7.2% in the first half last year to 11.8% in the first half of this year. Can you break down where the margin recovery came from specifically, and which of those margins drivers do you consider sustainable and durable in the second half and beyond?
So one of the drivers of our improved performance has been volumes, and the second has been how we have managed the cost. The significant aspect, obviously, the volumes, and also you will notice that there was a price growth, mostly driven by the increases in copper pricing, and we then managed to convert that price growth in such a manner that it filters down to the bottom line. So in terms of sustainability, or in terms of sustaining the performance, we do believe that the growth in volumes, we can be able to maintain the trend as we go up the level that we have achieved so far. You will recall, in terms of our strategy, in terms of gaining market share after the removal of, or after we were operating under some import restrictions from a market perspective, and we were benefiting quite significantly. But after the removal of those restrictions, everyone was bringing in cables in country. So we realized that if we do not take the initiatives to protect our market share, were going to lose out. And therefore, what we then did is that we went to our channel players, channel partners, the distributors, the contractors, the installers, and we positioned ourselves to them as more of a supplier rather than a competitor, as it were in the past. And therefore, we have sought to trust these channel partners to promote our business with the end user. Whilst we communicate with the end user, highlighting the benefits, the capabilities that CAFCA has got compared to the other products, we still believe that the channel partners, they remain very critical, and will always be prioritizing them in terms of our distribution channel or our route to market to the end customer. So that has been one of the things that has sustained us, and we believe that we'll be able to continue to sustain that. Then the second aspect, which will always be very pivotal or important to us, is our ability to achieve the very convenient lead times. We have got a factory. If a customer comes here and they need something that can only be, that we do not keep in stock, or that any other producer doesn't keep in stock, our turnaround times, like I've mentioned, we improved our capacity utilization, our equipment reliability went up, and therefore, if a customer requires something in 3 days, we can be able to meet that, regardless of the processes. Remember, there is the aspect of acquiring the raw materials, lining up with the production planning, and all the other interventions that are required from a production perspective. CAFCA has got the capacity to, or we've developed the flexibility to deliver within short lead time. So that capacity, we believe that it will continue to give us an extra edge, especially with our B2B customers. The customers, the big mines, the industrial companies that are looking to expand or that are buying cables for their own consumption. So we feel that that market will always be able to service it better. The third aspect that we then did, you will notice that there was always this concern that CAFCA products are pricey. But obviously, because we give value, we support our customers through quality and through after-sales service. But over and above that, we believe that we had to make sure that our pricing, our price point is competitive across the region. If you come to us, we can be able to match or be better than anyone in the region. Than regional players.
Even local.
Even local players. So that is what we have been doing to ensure that we defend or we protect our market. So the growth in volumes, I believe it will be sustainable and will continue to grow. We have put the customer at the center of what we do. And it's a simple strategy. Once the customer feels that they are important to our goal, I believe that they will continue to come to us, or they will continue to favor us. Then you will see the pricing aspect, which I had mentioned that it has been driven by the fluctuations or the increases of the London Metal Exchange price. That, unfortunately, we do not have much control over. But we believe that our conversion of the fluctuations has been much more efficient. Maybe as we look forward, you will see that in the beginning of the year or towards the end of the year, we realized that the prices were going to run away given the Middle East war. Already there were talks that the price was going to breach 13,000, but now it has breached 14,000. So we went ahead and stockpiled. We created quite a huge stock runway at a lower base, and that in a way helped sustain our margins. So we believe that that is not so sustainable, but we believe that we'll be able to continue to convert better.
So in the export business,
Yes.
you've seen that you have grown your exports by 109%, which is the strongest operational number within the financials.
Yes.
And this came after you take a decision to remove the consignment stock system, which was clearly transformative. But why did this take so long? What was the logic behind delaying it?
Delaying the change.
The change.
So there are two things to. So you know the change from a consignment stock model to a direct source approach. You know, it was one of those bold decisions one had
That we
to
have
take.
made.
One, the consignment stock model had an impact on our working capital. We had, in fact, in terms of our stock turn, we were probably 0.5 times in terms of what we were getting. And therefore, we ended up more or less financing our distributors to a large extent, as they were holding this stock for more than 6 months before converting that into revenue. And over and above that, we realized that if we continue on that path, the recoverability of the money that we had sent out was going to be such a huge factor. So at the end of the day, we had to change. So that was a matter of working capital management and a matter of trying to optimize the little working capital that we had. The direct sales approach, obviously, it had its own advantages in that instead of relying only on the distributor to penetrate and look at the market, or to rely on the marketing efficiency of the distributor, by going there direct and getting to understand the market better, we had to reach certain markets the customers had not, our distributors had not ordinarily gotten into. And therefore, it gave us the ability to negotiate better, be it lead times or be it price. Or be it the value of the whole arrangement. So we have started to see the pockets or taking advantage of the pockets of opportunities, and therefore this growth obviously is coming from a low base. That is one thing that I have to acknowledge. I believe that there is more to come, and we should be able to improve even further.
You know, I'm actually impressed by the rise in exports, because it doesn't only benefit CAFCA, but it also benefits the country at large.
100%.
But last time when you talked, you said you were competing for thinner margins because of more imports, especially counterfeit products, as well as the 30% export retention policy,
Yes.
which constrained your margins. What has changed? Was there a positive change in that, or what?
So the last point which you have mentioned with regards to the 30%, then we were working with a runaway exchange rate. With a thinner margin, you are likely to lose that margin through exchange losses. And the initiatives by the central bank to stabilize, strengthen the currency aspect is really gone a long way to support our export strategy. But one of the things that I would like to mention, you know, if your local market and your capability to service the local market is limited, it's not as beneficial. It's not that beneficial to go for export. So one of the things that, like I indicated, that we had to do was to clean up our own capabilities so that we expand our capacity, and that we've done. And in terms of that capacity, like I said, our costs, they are more or less fixed. We are no longer have to pay overtime in order to produce goods for export, for instance. We now have that latitude to utilize our capacity even to get business with a lower margin. So the equipment reliability, the better utilization or the process capability that we have developed in the system has really gone a long way to give us that capacity as we go into the export markets. But one thing that I would need to mention is that, if we are to industrialize as a country, or if we are to benefit fully as a country, there is need for more policy initiatives. Just like you had mentioned, we had been impacted by the substandard products that have been coming through. We have been impacted by dumping activities by especially from the Asian, East Asian side of things, whereby certain products, not even going to the quality thereof, but they
pass through.
They just pass, or they arrive here, or they are being sold at lower than the raw material cost price. That is an unfair trade practice. That is something that even when we want to compete, we can't compete with an unfair trade practice. So those are some of the things that need to be addressed through policy. And obviously we are talking with the responsible authorities to look into these areas so that we, from an industrialization perspective and from an export-led growth of that industrialization initiative, we can then start to move forward as a country. But yes, it is the growth in exports is good for the country and for CAFCA.
You have just factored in one of the fundamental issues, which is dumping of goods, substandard goods, which are priced lower than the locally produced goods. But
than the raw materials, not the locally produced, than the raw materials.
Which is a very big problem.
100%.
But recently, the government has been passing measures and policies to control the local industry and even increase the border patrols to contain smuggling 100%. Of products. Have these manifested in your work?
Yes.
Have you seen any changes in the
100%.
policies?
There has been a significant change, and of which we welcome that. I think in the past quarter, or the quarter that we are about to finish, we have seen quite an improved position in terms of strengthening border control. There's been reduced activity of goods that are being sold, because the other factor which I also need to mention, which has affected our competitiveness, you will see that some of the dealers, especially the East Asian dealers that have been selling cables they sell without VAT.
Most of them,
they sell without VAT. And that, because we are a formal business, we are compliant with all the laws of we remit our VAT, our taxes, be it corporate. We are a taxpayer in good standing with the revenue authorities. But the other guys, they are coming into the picture without complying with all the laws of
the tax structures.
Yes. So whilst the border control is improved, but we now need to rein in on those elements that are informally, or they are abusing the informal systems to the ends of evading the tax. So that is still a leg which needs to be addressed by the authorities.
So what is CAFCA's medium-term target for the export share of revenue, and which specific regional markets beyond Malawi, Rwanda, and Mozambique are in the active pipeline to scale up?
So we believe that our existing markets, obviously we have got trade agreements with our sister companies from the Ronet Group, to the extent that the market, we have shared the markets in that manner. And those markets that we are pursuing, we are still at the lower quartile of what we can do from a market share perspective. So we would like to improve, we would like to increase the volumes of what we are sending, be it in the retail market or with the B2B, or like I was saying, the mining organizations, the industrial companies. You will see in Mozambique there has been growth in the northern side of the country from a gas extraction and so forth, and we would like to participate more. You know, Tete is closer to us than Maputo is closer to Tete. So we would like to participate more in Tete, in Manica province, in Tete province, in Sofala, going up Nampula and all those areas. Getting into Malawi, we want to largely control the markets. And the only way to do that is to get our product with the distributors or with the customers.
Yeah, and I also really believe that Mozambique, with the gas projects being done there, has the capacity to become one of the biggest economies, not just in SADC, but in Africa. But 100%. Now, you have talked about exports also being strengthened by currency stability and exchange rate stability.
Yes.
But Mr. Nyakudya, the exchange rate stability in Zimbabwe and current stability in Zimbabwe is mostly because of two fundamental aspects,
yes.
which is number one, the interest rate, which is at 35%, is the highest interest rate, not in SADC, but in Africa. It is the highest interest rate, number one. And the second aspect is also government delaying to make payments to suppliers, to contractors, which runs in hundreds of millions and billions. So are you comfortable with such type of stability? Don't you think, what's your take? Don't you think it's what government is doing, especially on delaying of payments? We have seen this before, when payments are delayed and at one point they are just paid at once and cause a havoc in the economy. Don't you think it's more like of a policy which government is trying to probably, let me say, stitch the bag to stop the area, but at the end, at one point it will pop up. What's your take on that? And so, also on the aspect of borrowing rates at 35%, are they convenient business-wise? What's your take as a company?
So from a business perspective, obviously it's a question of a chicken and an egg situation. So I think it's a difficult place where the central bank is at, from controlling the money supply. You know, the fundamentals, I do believe they will take time to build. It's not going, we have been on a period where things have not really been working out from a currency perspective. I think since 2003, we have been battling with inflation and all. And it's only now that we have had a sustained period of single-digit inflation, which we need to celebrate, which is commendable.
Yeah.
But the underlying fundamentals, like you rightfully say, I'm also, I do engage with through CZI, through ZNCC, with the Treasury, with the central bank. And their thinking and strategy is sound, given the fundamentals that are at work. I can't really fault them that much in terms of their approach. Obviously, we want better as a country. We want better. But in terms of interest rates, it will, like the initiatives to control the money supply via loans and borrowings, it's a noble initiative. The aspects of withholding, I can't say it's a noble thing, but there must be capacity. You know, we have been restricted from a liquidity perspective. We can't access lines of credit through the likes of IMF and stuff like that. So we have to make do with our own capacity as a country. And that capacity is gradually being created. Hence why we're commending on the efforts by the government to stimulate local production. Without local production, without companies like CAFCA, substituting the imports through local production, we are not going anywhere. So one of the things that which I'm also engaging the government on is how we can stimulate the industry so that it produces more. It counters the imports that dilute the capacity of the government to pay its obligation. You follow? So the production question is, most of African countries, they are driven mostly by the resource base, which are semi-processed, but not fully beneficiated. And as CAFCA, we are in the engineering iron and steel, and we beneficiate, we utilize copper, the grow copper cathodes, even we do try to get the recycled copper. That ability to convert that raw material into a finished product, it's a rare thing in country and it needs to be protected. And that is the initiative which I believe will then put the currency of the country in a good place. If we can produce, our currency will continue to be not viable.
So at the end, we are saying the current monetary policy or monetary strategy and the interest rates, they are necessary evils whilst the government is building fundamentals.
Whilst the government and the industry are building the fundamentals. So the aspect of building the production, so the currency is supported by production. We can talk about how
everything else.
But without production, without our own production, if we become a retailer of everything,
a net importer
of we won't sustain a currency. We won't have anything to back our currency with.
Then let us look at the power issue, electricity issue.
Yes.
You have faced. You lost something like 324 hours of production due to voltage fluctuations against 99 hours in the prior year. And on the positive side, the solar plant went live in March, which I do believe that it will change the calculus going into half year. But now, how does the solar plant specifically mitigate the voltage fluctuation risk? Because given that solar generation typically addresses power availability rather than grid source the power quality issues, how are you going to deal with that aspect?
So I would like to point out two things here. The solar plant and the grid. So the solar plant, primarily it was developed to lower our cost of procurement of power. That is the primary goal with the solar plant. It's to lower our production cost. Then secondly, the grid stability, which is a responsibility of one of our key customers, ZESA. So, and the major challenge that they are facing is the aging infrastructure. The substations, the transformers are old and they are now unreliable to the extent that they have to load more than the capacity of the substations in terms of people using the power. So that has been affecting us as CAFCA to the extent that our main utility of operation, which is the furnace, it cannot operate below a certain amount of voltage. And that, in fact, when we reported in the first half, it was actually better. Now it's worsening. The rate at which the performance is worsening. But however, through our engagements with ZESA, they indicate that this will be corrected and sorted out.
Good.
This will be corrected and it will be resolved as we move forward. So we are praying that we continue to resolve the issue of power, but in terms of production, there is quite a huge impact from that perspective. We have been losing power. I think it's actually an outage of power that is just occurred now. So talking about power, so I'm not sure whether someone at ZESA is listening to our conversation, but they just wanted to show the extent to which we are being affected by power.
By power outages.
Yes. So it's something that can only be resolved by ZESA. But I'm glad, like I said, we are working with ZESA, even from a conductor perspective. We are supplying, they have recently got financing, and we believe that most of their requirements will be resolved as we go from that perspective.
Now, we have seen a lot of production which is going on, including this solar plant that we have just talked about, and ZESA is gone again.
Yes.
That we just talked about. Did CAFCA applied for the targeted finance facility, or you have chosen to go by the lending route from the banks at 11% annum?
So
are you taking that chance of using TSF?
So maybe just from a financing strategy, so from a financing strategy, we would like to rely more on our own balance sheet to optimize it, because we believe it has got so much strength before we go to financing measures that will come at an additional cost. But for the solar plant, because it was, like I'm saying, it was a no-brainer looking at the financing model and the cost of procurement. For us, it's the solar plant is paying for itself, and therefore it was better to use a financing model. But in terms of the source now, we then relied on a commercial arrangement rather than a targeted finance facility. The targeted finance facilities were mostly coming in ZWL, was that in ZIG. So we wanted to go for a model that had enough runway in terms of tenure, and this financing is coming over a 3-year tenure, which will be enough runway for the plant to have not a significant impact to the costing structure or to the working capital model of our business.
So moving forward, will you leverage, given a chance, the targeted finance facility, given that you have just authorized 1.39 million capital commitment for plant and equipment? Will you factor in this aspect of targeted finance facility, or it's something that you haven't looked at right now?
So, given the, because you need to understand at what cost are these finance facilities coming at.
Now maybe you have to unpack.
Yes. So they are coming a little bit steeper. They are nowhere close to the 11% that we got on they are much
on the paper.
Yeah, they're on the solar plant. So they are much steeper. And given where we are in terms of the transformational phase of our business model, we wanted to ensure that we extract the financing from idle assets. Like you'll see on the inventory side, we were switching inventory so that we position it correctly. On the debtors, we were switching the data so that we get or we benefit from certain positions. And on the payables, again, we were switching the structure so that we optimize our working capital. So overall, we believe that going forward, we may not necessarily need external financing as it were. And therefore, for our CapEx, we have already made, as of half year, we had already made deposits for 2 extra machines over and above the solar plant. That the first machine should be here end of August. The second machine should be arriving end of September, beginning of October. So, or should be commissioned end of August and commissioned beginning of October. So these we have got capacity to finance internally as of now. So we are not looking at any additional financing at the moment.
Then let us look at the utilities segment. It declined by 17% due to liquidity constraints, and we have a pipeline of back orders. What's the actual receivables risk embedded in that pipeline?
I'm glad to say that already, as we speak now, we are starting to service those back orders. This is on the strength of a finance facility via Afreximbank, which the utilities have obtained, and we believe that in the next 3 months we should be able to clear the back orders. So it also takes away that credit risk on the data as you have been mentioning. So we are in a very good position with the utilities to clear the back orders.
So have you engaged ministries or probably maybe ZERA on the utility back order timeline? And at what point does this exposure become a balance sheet risk rather than a revenue deferral?
So we are constantly engaging ISESA, or the holding company, as well as the recently Mutapa, and the Ministry of Industry, the Ministry of Energy, including ZERA. So this is in a way to provide them with information regarding capacity, because now that they have got liquidity, their fear is that does CAFCA have the capacity to produce, of which that capacity is there. So we have been engaging on that on that front, and you know, CAFCA initially was just built to service ZESA. So the question of capacity, as much as they might then ask those questions, but CAFCA was designed to service the utilities. So we've got capacity to, so I just thought I should take advantage of that to reassure once again. But over and above that, because this is backed up by a finance structure, which which is sort of like an advance payment to us, we therefore do not have a risk from an exposure perspective. Over and above that, with ZESA, we have been dealing all along, and we have never had issues from an exposure, because we manage it together in such a manner that at the end of the day, it continues to be a win-win. No one suffers out of that relationship.
Then let us look at your outlook, and if we check from the financials, your outlook was very optimistic but heavily qualified. Can you walk us through what you actually expect in the second half to look like, probably number by number?
So I think you might have heard the interventions that we have taken, and we continue to take interventions with regards to our capacity through the investment investment into CAPEX. So we have got more CAPEX. In fact, we have put money in CAPEX, we have put money in equipment reliability to ensure that our equipment delivers when we expect them to deliver. In order to achieve those short lead times that I've been mentioning, our equipment reliability has to be high. So that box more or less ticked. In terms of our skills cover, we have been making sure through training and blooding in or resetting the structure to ensure that there is always that heightened attention to the quality that CAFCA is known for. So again, from a people perspective, we are taking. From a supply chain, we have organized ourselves. I think you might see on the balance sheet that there was an increase in inventory where we were preparing for, or where we were just building up that stock cover in light of the price increases. But going forward, I do believe we should be in a good space because liquidity-wise, or in terms of cash flow-wise, we have significantly improved. Overall, from a cost optimization or from a capacity utilization, we are doing fairly okay. I'm happy with that position. And therefore, in terms of the things that we can control internally, we have done our work. From a market perspective, with regards to the customer, I think I've already explained that we have had to do a lot of work to accommodate our channel partners in order for them to realize that CAFCA will always prioritize them, will always accommodate them, and they are better placed to deal with CAFCA than anyone else. So that we have, with regards to our B2B, in terms of lead times, in terms of value, from an after sales, from addressing their concerns, we have been doing that. So from a marketing perspective or from a sales perspective, we are likely to sustain the performance. But the qualification in terms of the outlook is coming as a result of the external factors that are affecting the supply chain. So our supply chain has been affected by the runaway price, copper prices, which is in turn impacting on the pricing of our products to the end customer. We were hoping that by now this Straits of Hormuz issue, the war in Iran would have been resolved, or it could have been
solved by now.
Exactly. Yeah. But unfortunately, I think even the players that are involved in this war, they never saw this prolonging or going this far. So we are uncertain with the outlook in terms of the copper pricing or the raw material pricing. Most of the supporting accessories, like the compounds that we use for insulation, they are petrol-based polymers, and they are petrochemicals, kind of. So they will always be affected together with the price of fuel. So our raw material costs and the general supply chain disruptions, they put us in an uneasy position going into the future. And it is one thing that we need to pay attention to because it affects our customers, it affects us as well. So those are some of the things that we need to address going forward as we go to the end.
So basically right now we have seen positive outcomes in the economy, especially at macroeconomic levels. You see a bumper harvest maize. Yes. The same is happening in tobacco, the same is happening in mining.
Yes.
But there has been flagged a probability of a 94% El Nino event. Yes. Going into 2026, 2027 season. Then with that probability and probably with copper prices still elevated, how will be your outlook look like?
So this will likely affect us in the coming year, in our next financial year. So as we go into the final quarter of our financial year end, we are fairly confident of how this current year will close. But going into the next year, Zimbabwe is an agrarian-based economy, and once the agricultural side is impacted, then it affects everything. The economy will shake one way or the other. Yes, we can say that the mining is performing very well, this and that, but our economy is supported by agriculture. So this El Nino is giving me sleepless nights. Unfortunately, it's one of the things that is outside of our control. there is no particular strategy that you can put in place to prevent
such a natural event.
100%.
So right now we have seen government implementing regulatory reforms across major sectors, almost all sectors of the economy, from agriculture, from mining, from manufacturing, and one of them we have seen government mandating producers to buy 40%, to source 40% of their raw materials locally, and then probably up to 80 to 100% by next year. What specific policies do you want government to put in place specifically for electrical and cable manufacturing, and how quickly do you need to see them?
So, you know, like I indicated, that our currency is backed by production, by industries. And CAFCA is one such unicorn in the industrial or in the engineering, iron and steel. We have just had Disco, Dinson steel company coming into the fold, and you can see how we are celebrating that, because it is capacity that will put Zimbabwe on the map.
Which is currently the biggest one that we have in Africa.
But CAFCA is another such company that needs to be prioritized in such a manner. You know, there are anchor industries in every sector, like in the iron and steel, there's Disco. In the copper, there's CAFCA. I do not know any other company that is strong on the copper. And therefore, that whole value chain needs to be built in such a manner. You know, there's ZESA on the other side, there's CAFCA. That whole value chain needs to be built in with that mind to say, how do we protect this industry? How do we leverage on the existing capacity so that the offshoots of that industry, it starts to be felt? How do we not lose energy or capacity from that industry? Because at the end of the day, as much as we may talk about Africa free continental trade area arrangements, without thinking of how we protect ourselves, we'll continue to be at the mercy of countries, of other countries, like the Eastern Asian countries that are more or less dumping products in the country.
In the country, yeah, which is actually a case in disguise.
100%. Yeah. So as much as we can go for free markets, but we need to have a balance. There is no country that relied solely on free markets and survived. So there is need for a balance. What do we protect and how do we protect? How do we engage? How do we build together? So that is the thinking that I believe that the government needs to adopt as we move forward. I know the minister always say, I do not believe in protection or anything, but you will notice that countries like China, which are, okay, I would always say is the number one industrialized economy right now. It works from a planned economy perspective. Like you would hear as recent as of 2 months ago up until end of June, they banned the export of sulfuric acid because they realized that there was going to be a gap. They then sought to protect their own industries. So even if you look in terms of how they influence the commodity markets, it's from a central thinking. So every one of them, they engage and say, you know what, as a country, we want to go in this direction. In terms of copper, how much copper should we be holding for us to take this position? So that's the similar approach that I think we now need to adopt as a country. If it's iron and steel, how do we nurture and how do we develop the value chains so that the distributors, the contractors, everyone in the market benefits from that value chain? Similarly, from a CAFCA perspective, the distributors, the contractors, and everyone, how do we maximize on the capacity that we have got? It's sad for me when we have to maybe let go some of the stuff because we can't satisfy, but the uptake of our products is so low that we can't justify
huge numbers.
So those are some of the things that there is need for continuous engagement and for continuous thinking in terms of how we utilize our own capabilities and capacities. We need now to move away from that expedience kind of thinking where we are doing things out of expedience, but we need to be doing out of a strategic thinking and a strategic plan. We need to understand what success looks like from an industrialization perspective.
So given that current stability remains, given that government continues to protect the local industry from dumping of goods, and also given that government continues to implement changes, especially money tightening, this is the phase that we have seen Zimbabwe sustaining a positive monetary trajectory where the inflation is contained, where money supply is contained. Given that all those are in position, how do you see CAFCA's domestic market and where do you see it going?
No, it can only be growth. So CAFCA on its own, we, like I said, we are not stopping to improve or to grow our capacity, to grow our capabilities. So we have been known for making quality cables. And you will realize that we are probably one of the few companies with that much consistency in terms of quality.
I can actually say the largest company.
100%.
Which is always on track.
So I always say, especially when it comes to when the competitive products, that our customers need, they can, those who are saying, CAFCA iri kudhura, ngavambotrai dzimwe. Ndo panoshanda statement rekuti nguruve inokangwa nemafuta ayo. So in
zvakachipa zvinodhura, cheap products are expensive.
100%. So you will see that what I'm trying to say is that whilst CAFCA is building its own capacity, we understand that the products that are competing with us, they are much more inferior. And we have also allowed our customers to test it for themselves. And in most cases, they've been found wanting. I've got quite a number of cases as recent as of this year where customers have had to come back, even big contractors, they've had to come back and say, you know what, can we have the proper cable? And because here in country, it's CAFCA and ZESA, we have got the testing capabilities. And some have even asked us to come and do testing for their cables, but unfortunately they have not been of the right quality. So it's up to the customers to try other products, but we will always encourage them to try CAFCA. So from a growth perspective, we believe that CAFCA will continue to grow, but we would like also that growth to be a collective approach whereby we grow as an industry, not just CAFCA alone, but the rest of the industry. So like you rightfully put, I do believe that CAFCA has got a good growth trajectory or a good growth story.
I also do believe that right now we have a listening government. We have talked about currency and it has stabilized, though we have some backlogs in paying, in making payouts. I do believe that we have one of the most intelligent ministers. He knows what he's doing. And I do believe that the government will listen to what we have been saying, and whatever case that we have raised, it should not give a deaf ear and a blind eye. We actually, at the moment, have a listening government, and I believe 100%. They will listen 100%. And deliver.
100%, yeah.
So actually, thank you again for having this conversation. It was very insightful, and I wish you the best going into second half, not just second half, but even
into the
beyond.
Future. No, thank you very much, Blessing. It's been a pleasure. Like you've rightfully put, we do believe that the more we engage, the more we talk, the more everyone get to understand. And it's good, like you are rightfully saying, that we are in a period where even the government is making an effort to correct the imbalances in the market. and that needs to be acknowledged. From a currency perspective, from a market dynamics, from a border control, even from a value chain perspective, as we seek to industrialize Zimbabwe, from a CAFCA perspective, we say, let's do it together. Even as we build Zimbabwe, let's do it together with CAFCA. Thank you.
Until next time.
Next time.